Hi, everyone. Welcome back to Your Money Matters. I'm Angela Giroux, publisher of the Bauman Letter. And with me are Ted Bauman, our editor, and Clint Lee, our research analyst. As always, a reminder, there is a link below if you want more details about the Bauman Letter and how to join. But today we're going to take a look at the markets in a different way. And I'm going to start with you, Clint, because the markets have been very volatile. And I know that you, because of your background, have an interesting take on the markets and how you could play these sort of shifts that we're seeing. So if you could just talk a little bit about this market action.
Yeah, absolutely. And so, we've heard a lot in the media, the financial media, just this last week about all the volatility between whether it's growth or value or small caps and large caps. But yeah, I wanted to look at it today through a different lens, but just to make that connection, first I do want to show just a chart of how growth ETF has performed relative to a value ETF. And I'll show this spread in performance on a year-to-date basis here with this chart. So the value ETF we're using here is IWD, and we're using IWF to proxy growth. And this just looks at the absolute value of that spread on a daily basis, because what I'm interested in seeing is how volatile this year has been already, what this has looked like just over the last week or so. And so that's what we're highlighting with this arrow on the right-hand side of the chart on here. So this spread absolutely blew out on two occasions. One was right after the election. We initially had the relief rally amongst tech stocks because we didn't see that blue wave. And so we had a big spread there. But then it got even worse when you saw Pfizer's vaccine news. And that sent that trade completely the other way. All these reopening cyclical stocks surged higher. And that's the bar I'm pointing to on here with the arrow. Now, this is the common way that a lot of people like to break down the markets, but you can also look at these things through the lens of quantitative factors as well. And a lot of people talk about momentum investing, but what gets lost is that momentum is actually a stock factor. It's a way to rank out stocks. And you can track, and there's hundreds of these types of factors out there, and you can track how they're performing. So I thought it'd be interesting then to look at a similar dynamic just over the last month, how these factors have performed. So here's another chart. This goes back about a month or so, and this shows a value factor ETF in the blue line on here against the momentum factor ETF, which is red. And then I put the S&P on here as well, just to frame up the comparison. But this is over the last month, and you can see how these lines kind of going into the election started to converge a little bit. There was, the anticipation of a blue wave that didn't happen, but then as soon as we got that Pfizer vaccine news, these spreads just absolutely blew out, like you saw in the prior chart, where you've got momentum just got absolutely crushed. That Monday earlier this past week was the worst day for the momentum factor in recorded history, going back at least 20 years or so. So you're seeing a lot of volatility in these factors as well. But just to frame up the big picture, if I take this same chart back on a year-to-date basis that I'll show you right here, even with that big reversal, this momentum factor is just still absolutely trouncing not just the market, but value stocks as well. You can see value is the blue line on this chart still. Momentum being the red line. And even with that big one-day reversal in performance we've seen, momentum has still outperformed pretty much every other factor in the market this year.
Well, I would like to mention for those of you watching that Clint has a nickname around here. He might not be happy that I'm sharing this, but we like to call him the king of the quants. So he is in a great position to be talking about this stuff. And I know you had talked about this sort of Quant Superquake. Do you want to elaborate on that a bit?
Yeah, sure. I mean, so.
Sorry.
That's fine. Yeah, so with what we saw on Monday, once again, that being sort of this worst performance in 20 years, that's what they're referring to. There's a couple articles out there talking about this historic performance, or underperformance of the momentum factor, because it's even worse than when you go back to the financial crisis. So I was watching this. I lived through this during the financial crisis, and when we got to March 9th of 2009, it was just a huge reversal in momentum factor. A lot of the value cyclical areas took off, and I never thought I would see anything in my lifetime that would eclipse that. But lo and behold, this past Monday, we saw exactly that.
Clint, I want to. I think you've nailed it, and I want to maybe if we can go back to that second chart that you showed with the factor performance percentage change over 1 month, and just point out something. And I think it's a real challenge to investors. If you look at the performance of value and momentum versus the S&P 500, if you weren't looking at those two factors separately, if you were just looking at the index, you wouldn't really know that anything was happening. And I think that's a real challenge to a lot of investors, that they haven't figured out a way to try to distinguish between these different factors, and they can't really do it. And I think that's the real challenge. So for me, the big question is there an alternative? Is there a way for you to be able to tease out which stocks you should be looking at, maybe even for very short-term trades? What's the method you want to use?
Yeah, I mean, the method. Look, these factors exist for a reason, and there's a reason why there's so much attention levied toward them. It's because over time, despite what you've seen over the last month, despite what you've seen on a year-to-date basis, say with the value factor, over time these things have been proven to outperform. Undervalued stocks outperform expensive stocks. It hasn't happened this year, but on a longer-term basis, that occurs. High momentum stocks outperform low momentum stocks. And that's just a simple example. There are hundreds upon hundreds of factors out there spanning these numerous categories, and they have been absolutely put through the ringer to prove their performance by both academics and practitioners alike. Asset managers perform their own studies, release their own white papers supporting the validity of using these. So what's nice is that instead of getting caught up in the traditional growth versus value trade or large cap versus small caps, here's a subset of factors that have been proven historically to point you toward which stocks, the top ranked stocks on those factors, they point you toward which stocks have the best characteristics to outperform going forward, instead of getting caught up in this volatility and trying to guess which way it's going to go.
Right. And again, I should mention that Clint has spent a lot of time studying these factors, developing a system. You used to work at a fund, and now you're with us, thankfully. And can we talk a little bit about the system that you've been developing and testing that looks at these factors and gets them to work in your favor?
Yeah, sure. As you mentioned, I did this before joining Ted's team. I've spent over a decade now actually building, testing, and implementing these types of quantitative models. And over the last year or so, I've been developing a new model, one that takes into account dozens of factors spanning different areas of the market, not only using these momentum quality type factors, but looking at things like analyst revisions and credit risk. And in my back test of that model, just kind of putting everything together and looking at sort of how the top ranked stocks perform relative to the bottom ranked stocks. Over the last 10 years, that spread in performance is about 19% annualized. So on an annual basis, over a 10-year period, there's a 19% spread in terms of holding those top ranked stocks in that model versus the bottom ranked stocks. But then one of the things we can do from there is look to really two things. One is how can we leverage that performance for even better gains, and how can we do so by mitigating some of the risk that's out there? Because Ted, that's what you're talking about, just how volatile this market has been and what we can do to try to control the risk. And one of those things to achieve both of those goals is by using options. Options can help magnify the gains that we see, but then also with an option, your downside is limited to the premium you pay for that option. So as long as you're following a disciplined risk management strategy and you're not allocating too much of your trading capital to any one particular option, you're limited to that premium versus, if you're trading a full account allocated to a particular stock, or an ETF, and you wake up one day and you see sort of that spread in performance, at least with an option, you know the risk is limited just to what you've paid to be in that contract.
Ted, any closing thoughts on that?
I think what Clint is talking about is a brilliant way to play this current environment, precisely because you are putting so little risk on the table, and the upside is so big. And it's particularly, as I said, if you look at the market, you just look at the trend of the market itself, it's not telling you what you need to know, because you get this rotation within the market between these different factors. And Clint's system is able to pick that out and say, buy this particular option on this particular stock, and you have the potential for much greater gains over a short period of time. The alternative would be trying to bet on stocks with the entire amount of the value of the share price, which is a much riskier proposition. But the last thing I want to mention is just reverting back to my video from Friday about emerging markets. I just want to show a chart that pretty much proves, I think, what I was saying, because in addition to the options game, I'm still continuing to bet that emerging markets are going to do well. And as you can see, over the course of the last month or so, emerging markets have gradually broken away from the technology stocks, from the market as a whole, and particularly in emerging markets have done very, very well. So that's my final thought of the day. Play Clint's options, and let's look offshore for some money. I know we're doing that with the Bauman letter in our next pick, and it is just crushing it. We're very happy for that.
Yeah, amazing. It's up 20% or so in 3 days.
In 3 days, yeah. We really scored a winner.
On that note, I would recommend to everybody watching that you sign up for Bauman Daily. As a reminder, that is our free e-letter. There's absolutely no cost, no obligation to join, but it does get you to the front of the line, because we will be launching Clint's VIP research option service next month. It's coming up very soon. We're very excited about that. And you want to make sure you get in on that. So please click the link below, sign up for our free e-letter, or of course, the alternative is to sign up for the Bauman letter and find out our new double-digit winner in 3 days. Thank you so much for joining, and we'll see you next week.